Let's take a look inside a £1.3 million portfolio that's been put together by a financial advisor. What's its performance like? Does it have some really amazing funds? The owner of the portfolio is paying the advisor £13,000 every year just to have this portfolio, so it should be something quite special. The portfolio is of a man aged 65. It comes from an article in the Telegraph. I'll put a link in the description. He has a mix of pension and ISA, and he's looking to retire. First up, we have Dimensional World Allocation 80/20. So this is a fund of funds, invests in about 10 different funds to get a mixture of equities. So you've got small companies, world equity, emerging markets, value, and then it's got 20% bonds within the portfolio. So now here we've got a performance chart for the Dimensional Fund. It's gone from 14 to 20 over 5 years. So that's a gain of just over 40%. So when I look at the fund, I think, well, wait a minute, this seems to be identical to Vanguard Life Strategy 80. And if you look at the performance, yeah, they are pretty much identical. The problem is that Dimensional has higher fees, specifically when you take into account that Dimensional products are only available through a financial advisor. In fact, the next holding in this portfolio is Vanguard Life Strategy 80, which is a bit odd. So you've got two very similar funds and you're just using it to avoid maybe potential provider risk in terms of Vanguard versus Dimensional, just spread assets between those two. And the problem with a multi-asset fund is that how do you decumulate that fund? So when you go to spend it and sell it down, you're selling down equities and bonds at the same time, when in reality you probably either want to sell equities because they were putting in a strong performance, or maybe bonds because they were doing quite well, and you wouldn't really want to sell them both at exactly the same time. The next holding is Lion Trust Sustainable Future Managed Growth. So it's an equity fund. If we look at the top 10 holdings, we've got them here. Again, the top 10s often look very good because the best performers tend to rise to the top. Here's how Lion Trust Sustainable Future Managed Growth has performed compared to a global tracker. And we can see that in the tech boom during lockdown, the active fund did very well, and since then it's fallen off. It's not been able to make a new high, whereas the tracker has gone on to make higher highs. So overall, I think the Lion Trust Fund has performed pretty average. Next up, the advised portfolio has HSBC Global Strategy Dynamic Portfolio. And again, it's another fund of funds. We've got a lot of US equity in here. We've got some property in here, emerging markets. We've got some bonds as well. Next up, L&G Multi-Index 7 Series. So this is another fund of funds. It's got a little bit of bonds in there. It's got equities with the usual suspects like US, quite a heavy weighting to the UK. It's also got some thematic ETFs such as artificial intelligence. We've got Royal London Sustainable World, which is another global equity fund, very similar to its Lion Trust counterpart. And we've got the top 10 holdings here. And again, if we compare the Royal London Fund to a global tracker, it underperforms over a 5-year period. And here's the overall SIPP part of the portfolio, nearly £1 million, and the holdings are pretty much all equally weighted. So what are some conclusions from the SIPP part of the portfolio? Well, I would say that overall it's underperformed a global tracker, so performance is not that great. There's a lot of duplication in the holdings between the two sustainable funds and the two 80/20 funds. It's also difficult for the client to see their overall exposure to things like emerging markets or bonds, because rather than just having one emerging market fund that's say 5% of their portfolio, they've got emerging markets riddled through a series of holdings. As these holdings are funds of funds, then the holdings will automatically rebalance themselves, so they don't necessarily need a financial advisor to check in with you every year because the funds are automatically self-calibrating. As a disclaimer, not all financially advised portfolios look like this. I think there are some plus points in terms of, well, there's not too many funds in the portfolio. There's limited exposure to property and esoteric things like private equity. Now let's look at the ISA part of the portfolio, and oh dear, it's the exact same funds, all again pretty much equally weighted. That's quite a surprise. So the issue here is that an ISA should be accessed potentially before a SIPP, because an ISA is income tax free and yet it attracts inheritance tax. And so part of a SIPP portfolio would be something you wouldn't access for 20 or maybe 30 years. And therefore it could have a slightly different composition towards equities, for example. Another issue is that it doesn't seem to be that the financial advisor knows what the objectives of the client are. When does the client want to retire? What sort of things does the client want to do in retirement? I don't think the advisor has built a financial plan for his client. So is the portfolio worth spending £13,000 a year on? I think the answer is no. All the client gets is one Zoom call per year. And how long would it take you to earn £13,000 after tax? Maybe a couple of months. One potential solution is to go from unstructured, overlapping funds with uneven performance to a much more structured portfolio with core funds and satellite funds, and then clear objectives around the portfolio or parts of the portfolio. And the objectives could be income, growth, or capital preservation. So then we'd end up with a portfolio that's structured in such a way that every fund would have a specific role and you'd understand your exposures and why you have each fund in your portfolio. If you put together an ETF portfolio, it can have low costs and it's possible to do back testing on it so that you can look at performance, drawdowns, best performing years, worst performing years, and get a real idea of how your portfolio has performed in the past and how it might perform in the future. But things could have been worse. Here's St James's Place putting aside 426 million for client complaints around services that were paid for but not delivered. In the portfolio, there are no exchange traded funds and no investment trusts. And that's because financial advisors are only as independent as the funds available on the platform that they use. Financial advisors are an industry in need of disruption as they offer poor value for money. And hopefully, coaches like myself are one way of achieving that disruption. For some ideas on putting together a portfolio, check out these 3 videos looking at growth, income, and an all-weather portfolio.